Hello everybody, this is AK. I'm back. So in two recent videos I talk about UOB. In one I talk about its numbers, some numbers from its recent update. And in another one I talk about its chart. And I want to add to those things that I said. With regards to its fundamentals, it's still very strong, of course. But quarter on quarter, that means third quarter 2023 compared to second quarter 2023, we saw its net interest margin moderating, and this is has to do not only with the fact that funding cost has caught up, but it also has to do with the fact that UOB, just like DBS, has a lot of liquidity. Right, it has so much liquidity that it could not put all of it to good use, which means that it's not able to lend all the money that it could lend to enjoy a higher loan margin because its loan margin was actually higher quarter on quarter at 2.64%, right? But it cannot be indiscriminately lending money, right? It has to choose higher quality borrowers. So a lot of its liquidity surplus was actually deployed into high quality but lower yielding assets. Higher quality but lower yielding assets. So I can imagine them parking money with the monetary authority of Singapore, for example, right? So expect net interest income to be stable and not grow too much if it continues to find it hard to put money to work to enjoy higher loan margins. Right, and because of this, quarter on quarter, we could see weakness in net interest income, right? Zero growth, or it might even decline just a bit. So we could see the share price continue to come under pressure for that reason. But this might not be the case because net fee income for the quarter was at a near all-time high. Right, because of loan-related fees and record credit card fees. Record credit card fees. That means they have more credit card customers paying fees. And I mean, I always say we should be prudent when it comes to money and not roll over our debt. But obviously, there are many people who do that. And apparently, there are even more people doing that now with record credit card fees. And of course, that is a huge margin product for the banks, right? And so I think UOB will do fine because what it might not grow in net interest income, it can grow in net fee income, which is quite clear here, especially after full integration of Citigroup's consumer business in 4 Southeast Asian countries, doubling its consumer customer base, right? So I'm sure the credit card fees will do quite well, right? And so now if you look at the chart on screen, I said in a recent video that UOB's new support level is at $27 and it closed at $27.03 in the last session, right? So if we look at that is another long bearish candle, so we have 2 long bearish candles in a row. If we get another long bearish candle on Monday or the next session, then we'll have 3 black crows, which would be a very bearish candlestick 3-stick patterns. And if that were to materialize, we could see price it goes even lower, right? And we look at the momentum oscillator, the MACD is declining in deeper into negative territory. The money flow index is hovering above the oversold lines, which means it's not oversold yet. So like I said, right, $27 fundamentally I think is quite a fair price to pay for UOB. I don't think it's excessive. I don't think it's expensive. It is still above net asset value. I think about 10% above net asset value. But for anyone who has not gotten the foot in yet and they want to get the foot in, I think that's quite a fair price to pay. I would buy some if I wasn't invested yet, but I'm waiting to see if it could go a bit lower. Because like I say, I see long-term stronger support at $26 a share. Okay, so that's point number one, UOB. Point number two, as you can see on screen, we're going to talk about China. Specifically, the question is, can China recover? Intuitively, my intuition anyway tells me that China will recover. It is a matter of time. It's just that we don't know how long it's going to take, because China has plenty of resources at its disposal, right? Off the top of my head, I can think of the US Treasuries that is holding. It's probably the largest holder of US Treasuries together with Japan, and it has been selling US Treasuries, and it could sell even more to help shore up its own economy, to help shore up its currency, that kind of thing. But if they do that, then of course that will have ramifications on interest rates in the US and for the whole world, and definitely for Singapore. But there's something else, right? We're talking about China now. And in the problem that we see in China now really is something that they should have seen coming, is of their own doing, right? They allowed the property sector to balloon, to grow unfettered, until suddenly they decided, to crack down on excessive leverage and risk taking, and it crippled the growth of Ant Group, and it pushed real estate developers such as China Evergrande Group to the verge of destruction, right? So it seems to be very extreme, right? First, it was just hands off, and then later on, it decided it was going to get a tight grip on the situation, and that tight grip turned out to be a stranglehold. And now, investor pessimism in China is growing rapidly, and the benchmark CSI 300 index has erased all gains since its reopening rally last year, right? And capital is exiting China at the fastest pace in more than 7 years, according to reports. And this is piling extra pressure on the Chinese currency, the renminbi, right? Because when capital exits the market, that means there's less demand for the country's currency. The country's currency will, of course, decline, which is another reason for China to sell treasuries to shore up its own currency, right, to support the yuan. And the exodus of capital apparently has intensified in recent weeks as the nation's real estate industry crashes, and it has cast a shadow on the entire economy, right? So it is hard to see the light at the end of the tunnel now, right? It's not Evergrande alone now. There's also Country Garden Holdings, which has gone into default on a dollar bond for the first time ever. And this emphasizes the fact that it's in distress, and that the property market on a whole is in distress, and the failure to pay interest on the notes within a grace period that ended last week. That's Country Gardens. So a default is going to be official for Country Garden, right? It's not expected to meet all offshore payment obligations on time, and the company is now likely headed for one of China's biggest ever restructuring, right? So this one is actually going to be more serious than Evergrande, right? Because Country Garden was China's largest builder by contracted sales for several years before plunging to become the 7th in 2023. Right, even though it has declined, it still has more than 300 housing projects in smaller cities, and it has 70,000 employees. So the turmoil could lead to worse impact than from the debt default in 2021 at its peer China Evergrande Group, right? Because it has several times more projects than China Evergrande Group. So, like Mr. Piyush Gupta say, this problem is not going to go away in a hurry, right? But the Chinese authorities are really stopping at nothing to trying to revive the real estate market, right? Because it cannot let this continue, and the authorities have taken steps. They try to fine-tune policy, and they have relaxed down payment requirements, cut some mortgages, some mortgage rates. But the question remains whether it's enough to turn things around, right? And the thing is, the government has also ordered lenders to help ease credit crunches in the property and the local government debt market, because a lot of debt is also government related debt. It's not just the property sector, right? The local governments also has a lot of debt, right? And they have asked the lenders, which means the Chinese banks, to help ease credit crunches. But these will have ramifications, right, for the banks, right? Because it could be a drag on the systemically important lenders, right? And we know the big 5 Chinese banks. So if you are invested in Chinese banks, some people ask me, why don't I invest in Chinese banks? Because they are so trading at such a big discount to net asset value, and they pay good dividends and all that kind of thing. But we have to be cognizant of the fact that the real estate sector is a big part of the Chinese economy, and the banks have a big exposure to that sector. And it is not just how much money they are lending to the developers, how much money they are lending to the buyers of these properties. It is also whether they could see a net interest margin crunch, because China now is asking the lenders to help ease credit crunches. So there are many things that we don't know, and I don't see why I should go all the way to China. Go all the way to invest in Chinese banks when I can invest in our local lenders and have greater peace of mind, right? But can China recover? I think it will, right? But how long is going to take? So, contrary to what some people might think, AK is not bearish on China, and I do not think China is a basket case, is never going to recover. I have investments which have exposure to China, like DBS, OCBC. They have like 20 to 30% exposure to China. And like Wilmer has a huge exposure to the Chinese economy, the Chinese consumers, right? And of course, we have CapitaLand China Trust, which is of course 100% exposed to China. So I'm not a China bear. I think that the Chinese have plenty of resources at their disposal, and they will definitely bring all their ammo to bear on the situation, on the problems. It's just that this is going to take time. It's going to be a long fight. And if we still believe in China, like I do, we must have the patience and not be overly optimistic, but be pragmatic. Okay? Bye-bye.